Well, some encouraging economic news in the fight against higher prices. U.S. inflation slowed more than expected in June. Labor Department data released Thursday showed the annual inflation rate cooled from 3.3% in May to 3% last month. That's lower than the 3.1% rate some economists had projected. The latest reading marked its lowest level since 2021. Jeanna Smialek joins me for more. She's a Federal Reserve and U.S. economy reporter for the New York Times. Jeanna, always good when we get to speak. And the last time we talked, after the jobs report came out, now we have this new inflation data. Is this the CPI report the Fed has been waiting for?
I think it is. This was sort of unanimously across the board. Everything in this report looked really good. This was very positive news for the Fed. We saw, as you sort of mentioned in the intro here, we saw this big headline decline on the year-over-year number. We also saw an outright drop in prices just on the month-over-month basis. And so I think that combination, the fact that prices are actually moderating on a monthly basis, even if you strip out food and fuel prices, which we know can be very volatile, prices only very slightly climbed over the last month. I think all of this wraps together to be really good news for the Fed. This is the kind of moderate inflation that they've been hoping to see. And this is the kind of progress that'll take us back to their 2% goal over time.
What does that mean for when they meet in September?
So they meet next, actually, at the end of July. Most people don't think that they're going to make a move that early. But at that follow-up meeting in September, a lot of economists, a lot of investors think that a rate move, if things stay on track, is anything, pretty much what we should expect at this point. It seems likely that the Fed is headed for a couple of rate increases. I think the big question now is how many they're going to fit in before the end of the year. If they move in September, will they also then move in December? And we're just going to have to wait and see what Fed officials say over the coming weeks and sort of how data plays out from here. This is obviously very good news for them, though, and will allow them to get started on that process.
Sorry, rate decreases, right?
Rate decreases, yes, correct.
So that said, the Federal Reserve Chair Jerome Powell just said it's unlikely interest rates will ever return to the super low levels seen between the 2008 financial crisis and the pandemic. So what does that mean for Americans?
Yeah, so between the sort of 2009 crisis and the pandemic, we had interest rates that were regularly flirting with or at actual zero. So very, very low interest rates. What Chair Powell is saying is that we're not likely to go back to that, but that doesn't necessarily mean that we're going to have rates at these levels forever. So rates are at 5.3% now. That's obviously a lot above that zero level that we were seeing before the pandemic. There's a lot of room in between here and there. So I think what people can look forward to is potentially a world where we go back to something that allows your mortgage, allows your credit card payment to be a little bit less drastic than it is today, but probably not all the way down to where we were in that period after 2009. That said, there's a good reason for that. Growth is stronger than it was in that period. That was a long stretch of a very weak labor market and a very weak economy. And so the reason that rates are a bit higher is that we're having a much stronger economic backdrop.
Let's talk housing prices. They rose 0.2% in June and 5.2% from a year earlier. That's good news. Because it means it's really the slowest pace of year-over-year growth since 2022. So how does the Federal Reserve view this reading, and how should Americans view it?
So this has really been the most important shoe to drop when it comes to inflation and where inflation has been headed. We've been waiting for months and months and months to see some sort of slowdown in rent of primary residence, so how much people are paying for their rents, and it just wasn't materializing for a bunch of reasons. And this month, we finally saw a cool down in how quickly rents are increasing in these official inflation data. So the reason that this is such good news is it's going to allow overall inflation to really start to come down and really moderate in a permanent way, because it's such a big portion of inflation in America, just because if you think about it, what we spend our money on, a lot of that gets tied up in housing. And so, assuming this trend persists, this is very good news for the Fed. It should sort of convince them that their job is finally getting done on wrestling inflation back under control.
Jeanna Smialek, thanks so much for joining us.
Thank you.